Hello, chart watchers, and welcome to this Wednesday, December 20th, Market Watchers Live show with Erin Swenlin and Tom Bowley. I'm your host, Tom Bowley. Today's show is being recorded, so you should be able to play back any or all of Market Watchers Live at your leisure. If you're unable to attend the show live, you can now go to www.stockcharts.com/webinars, follow the link to Market Watchers Live, and play back the show. Each show will be archived on our site until the next show begins, so you'll have roughly 24 hours to review. If you'd like to review an older show, you can now find those at our YouTube channel or on Facebook. During today's show, please feel free to submit ticker symbol requests, questions, and comments using the chat window next to the video player. Later in today's show, we'll select stock symbols from your requests, and we'll use those in the 10 in 10 segment at 12:50 Eastern Standard Time, where I'll attempt to annotate 10 stocks in 10 minutes. Market Watchers Live now airs 5 days a week, Mondays through Fridays from noon to 1:30 p.m. Eastern Standard Time. If you'd like to be part of the show, you can reach us via our chat room or Twitter. Our Twitter handle is at Market Watchers Live. That's at MKT Watchers Live. As you leave today's show, we'd love to get your feedback. In the lower right portion of your screen, you'll see a How'd We Do section with a link to a very brief one-question survey. Let us know what you think of Market Watchers Live, and feel free to provide us suggestions for improving the show. For those of you joining us for the first time today, welcome to the show. Certainly glad to have you. And for our regulars, welcome back. Before we get started, a couple quick announcements. We do have Greg Schnell in the house with us today for a point and figure review. Also, this Friday, we're going to have a year-end review, a special year-end review. So mark your calendar. Hopefully you can join us on Friday. After Friday, though, we will not have any Market Watchers Live shows next week between the Christmas and New Year's holidays. So, of course, the market will be closed on Christmas and New Year's, both Mondays. Tuesday through Friday of next week, we will be rerunning some older segments, including special guest interviews that we've had in the past, along with some educational segments. We will be providing you some details here on the webinars page in future days, throughout the week. So continue to look back to see what we will be broadcasting. Our live show, though, after this week, will be back on Tuesday, January 2nd, 2018. And with that, I'm going to bring in my co-host, Erin. How are you doing this morning?
I'm doing quite well. The audience has no idea, but our prep time this morning was absolutely hilarious. And we're going to bring some of that on when we bring Greg. And I'm planning on mediating between the two of you.
We're going to bring him in right now, but you won't need to mediate right now. How are you doing, Greg?
I am very good after I shoveled myself out of the snowbank this morning. So, yeah, life is good.
Yeah, it's 60 or 70 degrees down here in south of Charlotte. So just wanted to let you know, maybe that'll help you feel better as you're out shoveling.
You know, all those romantic comedy Christmas movies? Well, we could film a couple of them right here. You get snowed in for Christmas. The airplanes don't work. So everybody has to go back home. And yeah, so we got it all going on. Come to bed for Christmas. So.
How much snow did you get?
Well, 15 inches between 6:30 last night and 6:30 this morning. So, and it's still snowing.
Okay. If I saw that, I wouldn't have a snowman out in my yard. I'd have a for sale sign.
That's it. Well, I would never be there. So I wouldn't have to worry.
That. And then there's that. Good point, Erin. All right, we're going to get into all of this. We should be a great show today. I'm going to let Erin take over, walk you through the agenda of some of the segments we'll be going through today, and then get into that first market update. We'll bring Greg back just a couple minutes.
Indeed. All right, so we do have Greg here for the point and figure review, which I think you'll all enjoy. 10 and 10 to 1 is still on the agenda, of course, and what is interesting, and I add this separately, is we are going to do our agree, disagree early. And Greg has agreed to join us. And yes, it should be a lively discussion. 10 and 10 to 1 will follow. And we're first going to look at Chicago Bridge and Iron, CBI. So if you want to go take notes so you can compare them to Tom. And then we're going to have a correlation discussion between the Treasury yield and the SPX. We're going to try and start doing correlations once a month or so. And then we will wrap it up with mailbag questions and away we go. Let's get this party started with our first market update. All right. And for our Canadian friends, I went ahead and adjusted my my candle glance to include the TSX. I know we've had a lot of people asking about that, so I've added that. I took out the Wilshire, just so everybody knows. So the Dow, you can see it's a pretty volatile trading day when you look at the Dow and the S&P 500. However, after some very crazy movement this morning, we are sitting at mostly unchanged. NASDAQ has had a really great open, and then it just fell apart. But now it is trying to recapture some of those losses, just a little bit down, just a little bit, 696. We can see Russell 2000. Small caps actually have stayed positive all day long, but I would be a little concerned about a possible double top here. We'll have to see how that comes through, because we also have a little bit of flag there. TSX also mostly unchanged, as we can see, similar to the Dow and the S&P. Treasury yields are up slightly, reading at 24.81 right now. UUP started the day not looking so good, but it is trying to regain some of those losses and has formed what could be a little bit of a flag there. We can see commodities are higher at this point, looking very similar to USO, which is having a good day, although it is pulling back from intraday highs currently. GLD is riding higher, nice rising bottoms trend line here that's not even been quite tested today. And the VIX opened pretty low there at a reading. Actually, we got one below 9. Now we've started moving back up, but a reading of 952 is still pretty good, and still tells us that investors are feeling bullish more than likely. So let's go to our main dashboard. I want to give you the market summary very quickly for the major industry groups and sectors. And as we can see, Dow transports are having the best day now, right up there above 1% change. Utilities are the ones struggling, and as you can see, NASDAQ 100 and S&P 100 are all negative right now, with all the other indexes in the positive. Sector spiders, energy is leading. Consumer staples is in the bottom. We can see yesterday it was reversed. Consumer staples were doing much better. And we can see, as far as U.S. industries go, oil services, gold, natural gas, commodities basically up there in the top 3 selections. And we can see that REITs, drugs, hardware are the laggards currently. As far as international ETFs are concerned, Malaysia, Taiwan leading the top of the pack. And the laggards right now, Switzerland, Germany, and Netherlands. So that completes our first market update. And I'm going to hand it back to you, Tom. I know you have a few announcements.
Yeah, thanks for the update. It's a pretty interesting day on the market, no doubt about it. A little bit of volatility, as you said, but the overall uptrends continue. And I suspect that we'll see that into year end, simply based on the seasonal pattern. We know that December is the best month of the year by far on the small cap Russell 2000. It also is a very strong month, the best month of the year for the S&P 500. The NASDAQ, the only month better than December for the NASDAQ is January, which is waiting on deck. So it's from a seasonal perspective, it certainly makes sense what we've been seeing in terms of the price action. I would suspect that we'll probably see that continue. At 10 o'clock this morning, we had November existing home sales come out, and I would say that the home construction group hit the trifecta. On Monday, we had the housing market index out, 74 versus 70, came in much better than expectations. Yesterday, we had both housing starts and building permits easily beat out the Wall Street estimates. And then this morning, we saw the existing home sales come out better. So there was really, 3 key reports coming out this week on housing, and the bulls won all 3. Now, I'm going to go over that in just a minute. But one thing that's really interesting, we had a huge rally in the Treasury yields yesterday, and we saw a closing breakout and then a gap up today. Don't exactly like what's taking place so far with the gap up. It's just kind of holding at this point. We'll see how we finish. If we were to leave that little candle on an island and gap back down tomorrow, we could see a short-term top going in. But I think that the overall trend here is higher, and I do expect that we'll see Treasury yields continuing to move up. If we pull up the home construction index, though, and I wrote about this a little bit in my blog this morning, notice we're not, even though we've had 3 huge days, great news, notice we're just kind of going flat. And I'm going to shorten this down to just a few months, because it's really hard to see. We've had such a big move, this huge rally over the last 3 months. But if you notice, with all of this great news coming in for home construction stocks these past few days, we're really not going anywhere. And I think this is just back to that old Wall Street adage: you buy it, you see, strength on rumor, and then you see the selling after the news hits. And I think that's what really we're doing. I think that the market has been anticipating, and this is a beautiful case study of what technical analysis is all about. The price action all happened before the reports came out. So we've seen great numbers, but the problem is we've made such a huge run up that now those who have been anticipating the news are actually selling into that news. And so you got some jumping in with the great news, the great fundamental stuff, but those astute technical traders are actually using this to take some profits. So I would suspect that we're going to see home construction continue to move sideways and frustrate those who are trying to, looking at the news, wondering why we're not going higher. One other thing I just wanted to point out here on this chart, and a reason to bring it up. I'm sure the data feed was incorrect coming into stock charts, but we were trading on this index around 925 or so back in December. I don't know, was that December 6th? And you can see one reading up here around 1025. We never got to that. I suspect that the index was off by 100 points. But one thing you have to be careful about, because a lot of the indicators that we use are based on the actual price numbers, the stochastics reading is not really particularly accurate on this index right now, because the way that you calculate stochastics is looking back at a price range, not just closing prices, but intraday as well. And it looks at where you're sitting now relative to where you have traded in the last 14 days. And if you go back, this candle right here is in that 14-day range. And as a result, you can see stochastics have just kind of fallen all the way back down here, even though technically we're pretty close to the upper end of the range. So just wanted to point that out, make you aware of that. Anytime you see something like this where you've got a 10% intraday move to the upside, I would suspect that there's been an improper reporting of the data to us at Stock Charts. So anyhow, just wanted to point that out. With that, I mean, the FANG stocks, which were getting hit yesterday, let me just point out a couple of these real quick. Facebook continues to trade a little bit lower. If we look at Amazon and Apple, you got Amazon still moving down just a little bit, but they're all in uptrends. Apple, which is pulling back for the second day in a row, just broke out to an all-time high 2 days ago. So there's really nothing bad technically happening here. You've got Netflix, which is probably, of all five of these stocks, I would say Netflix is the one that technically is maybe the most challenged. But even still, this one is in an uptrend as well. Probably would like to hold on to the recent low that was printed in early December. And then finally, Google, which had pulled back from a breakout, pulling back again today. So it's showing a little bit of weakness. But again, just broke out to an all-time high 2 days ago. Let's give it a little bit of room. My suspicion is that if it does get back down, and that this would hold true for most of these stocks I just went over, but if they get back down to the rising 20-day moving average, I think you're going to find some buyers jumping in from a technical perspective at that point. Two earnings reports that came out today, and I think you pointed one of these out a few days ago, Erin. BlackBerry. I think you liked the way that the momentum was going on this stock, and it turned out to be a pretty good call, because BlackBerry reported their earnings. They came in, I think it was a 3-cent profit, and the market was expecting a loss of 1 cent. So they came out with nice earnings. I tell you what, I don't like this long tail to the top. And if it fails to hold this breakout above 1175, for me, short term, I think that could be a warning sign. But,
I agree.
Yeah, we'll see how it finishes. But I just wanted to give you some kudos there. That was a very good.
I got some kudos in the chat room too, so that was nice. Thank you all.
Yeah, absolutely. And General Mills also reported. This one is up. Look at the move to the downside earlier today. It did go down, I think, a couple bucks or maybe $1.50, but it has recovered up nicely back near the high, and it is at a pretty important resistance area here at about $58, $59. So I think that where this one goes from here is really important technically on the chart. But this one, I think, may have met earnings estimates. I think it was 82 cents. The market was expecting 82, and it came in with that number. So I guess traders right now are just trying to figure out which way it's going. But I do like the uptrend and the fact that it keeps holding this rising 20-day on the pullback. So I think really the trading range on General Mills is squeezing between resistance at, say, 58, 59, and then the rising 20-day moving average, which currently is at just a little bit above 56. So with that, I'm going to turn it over to my good friend Greg Schnell, who's going to give us a point and figure review. Take it away, Greg.
Okay, let me just grab the screen here. And go get
like your screensaver.
Okay, there we go. Okay, can everybody see that point and figure chart? Just want to make sure that we're in gear here. Now, what I've done is I have set up this list. Let me go here. I'm going to just show you the summary briefly so that everybody can see what we're going to cover off today. But I agreed to come on today just to do point and figure charts. So we're not going to look at things from regular charts. Everything in this presentation will be about point and figure. And what I've done is I've outlined kind of the US markets first, then North America, then go over to Asia, then work our way through into Europe, and come back into South America. So we're kind of going to go around the world and just look at the charts there to see the big picture. And then what I've done here, and somebody asked on the chat room for me to add Vietnam. All of the other countries I've got set up in their own currency. Vietnam will be set up in US dollars. So just we'll have to watch for that. And then I quickly want to get through all of the crude. And the reason I wanted to do the commodities, the reason I want to do that is the commodity charts are a little more mixed. They're not quite all bullish and pointing to the skies. So anyway, that's an overview of what we're going to cover in the next 15 minutes here, just kind of fire through. But briefly, I want to explain a couple of things about PNF. So one of the things is this move has been so high, I've had to shrink my screen because if I set it up normally, I can't get it all on. So that's an awesome sign that, it's been a huge breakout. So here's the NASDAQ composite from 2016 and, just this big vertical move. And you can remember we were all worried about, can we get through previous resistance at 5,200? Well, that was a bit of a non-starter. We're way up here. This is where support is on a PNF chart. 4,900. We're trading at 7,000. So we're a long way from support, like 2,000 points. Just to zoom in and help everybody. First of all, point and figure charts, you can make them X's are rising prices. And then if you have more than a 3-box pullback, it would give you another it'll give you a column of O's, and then a 3-box reversal would take it the other way. So I've set it up with our chart setting so that the colors alternate for up columns and down columns. And then at the beginning of the year, this is January, February, March, the 1, 2, 3, 4, 5. And the way we handle October, November, December is we go A, B, C. What you'll see here is there is no A. And the reason is because in October, we didn't make a significant move. This was last year. We didn't make a significant move. And then in November, we actually rolled over. So we just stayed in a trading range and didn't kind of form a new box higher or lower in October. And then November, we fell down and then we worked our way all the way back up. And then in December, we made our first change in trend. And then January, we were already on our way up. Now, this doesn't mean our first day of the month. This means the first price hit within the month. So this could have happened on January 28th or 29th. But the bottom line is that it just, PNF charts aren't so focused on time. So this is just really, when did it do that? So you can see in September, we kind of made a breakout here after having a pullback in August, and we turned up, and September made our breakout, and then ABC has just pushed steadily higher. So in October, as an example, here's September, and then A is October. So we were at 64 and to 6,500. So we've gone up 500 points in 3 months. It's been a very steep ascent. So the big picture on PNF charts, though, is you can see we're kind of trading back and forth in this zone back in here, 2015, 2016. And then all of a sudden we broke out to the upside. PNF makes those breakouts very obvious. And you can see here we had 2 X's that kind of topped the chart. And then we were pulling back. And then we came and we got to here. So this would be considered resistance. When we break above that, you're now moving higher, and it's very clear. This was previous resistance, so we got up to this level and we stalled for a while and tried to work our way through it. And when we finally got through it, it was like popcorn coming out of the machine. It just started to fly. So really, really big moves in the market here. Since January, this thing's just been up and away. And now we're just going to go to the next chart. And so again, we're going to do the US charts first. And this is the NASDAQ 100. The scale will change automatically as you go through different prices. All of these are still smooth, but I'll show you some charts in specifically the Dow Jones Industrial chart is getting close to 25,000. And at 25,000, it would change a scale. And the Korea chart changes scale at about 2,500. So I just want to make those points to you to make sure if I don't bring them up on those charts. But you could see support is down here at 4,600 for the NASDAQ 100. We're at 6,500. We're clearly 30 or 40% above long-term support. So we could wobble in here quite a bit. And normally when a market tops out, it takes a year or something. So there's a lot of people saying, we're going to have an imminent market rollover, and there's a lot of wave 5 of 5 discussion, and this is the final high and that kind of stuff. Well, it's been the final high all year. So the market has a lot of strength to it, a lot of breadth to it, and continues to push higher. So here with the NASDAQ 100, our latest column, in December, we pulled back a little bit and then turned and reversed right up. And what this red box with a line across means is this is what it would take to reverse. So it just tells you that if we get down to 63.50 in this particular case, if we got right to 63.50.00, not 63.50.99, but 63.50.00, we would get a circle in that box, and that would give us 3 rows down. So that's kind of how the P&F chart works. It's nice to turn on this feature. It just gives you an idea of how far you need to go. Right now, this is the current price shown here. And we're obviously continuing higher. There is a target method setting on PNF, and I was going to review how they were calculated for you, but I didn't quite finish that review. The big thing is it takes kind of the time it trades in a range and then expands that to the upside. So you could see clearly back here, we had a long sideways range, and we kind of built a double bottom on a big picture and then started to break out. And with PNF, you can measure these upside targets, and then it consolidates another upside target. So all of these are calculated moves. So right now, the bullish objective for the NASDAQ 100 is 66.99. Let's call it 6,700. And we're at 6,500. So this suggests there's a little bit more room to the upside. Okay. And, those are targets that you'd put out there. If you don't hit them, that's not that big a deal. But the important thing is, it's kind of suggesting that the market's got room to move higher. So for the Dow, it's got a target of 26,450, and we're at 24,700. So it's got another 2,000 points to go if we were going to get to this bullish price objective. The Dow has just been a ribbon higher. And you could see moving straight up, and we can go down and try to change this scale. We can adjust a little bit here. We could pick user defined, and I typically don't recommend playing with it. And the reason I say that is because, you can see this breakout here, and I've changed the scale so that every box is 150, and it's just pushed way up to the top. So every time this reverses and you get a column width based on that scale, the way the PNF charts work here is you set your width, and then that's how much data it will bring in, but it also affects the height of the chart too. So all these charts are so stretched to the upside, I can barely get them on my screen. And you can see here, though, very clearly when the Dow broke out in September of 2016 to new highs. It's been an unbelievable rise to the top. Okay, let's start speeding up a little bit here. So here's the Russell, and we could see that, it basically was consolidating and building kind of an indecision pattern where you had higher highs but the same lows. And so normally the market has to figure out which way it wants to go. You can see the lows continued to hold in this range. And then all of a sudden we make a big break to the upside. So currently we have a triple top on the Russell. And then if we were to kind of move past that, that would be a triple top breakout. We're on a buy signal right now. And the reason we're on a buy signal is because we haven't made a lower low. So back here, we made a lower low. So we would have been on a sell signal. And then when we reversed and made a higher high here, that would flip the chart to a buy signal. In this case, we still have higher lows all the way along here. And we have this triple top sitting here. So now the Russell's going to try and work its way through that triple top. But we're still on a buy signal because we've been making higher lows and higher highs. Bullish objective is 1800. We're trading at around 1550. So another 200 or 300 points on the Russell. I think we'd all be happy to see that. Tom's been pretty bullish in December on the Russell, and for good reason. The S&P 500. What we got going here is, just a big, beautiful climb. This is, basket of 500 of some of the strongest stocks in the world. And we continue to work our way higher. It would take a move down to 2,500 to get a reversal. We're still making higher highs here, made higher highs yesterday. You're in a bull market when you're making higher highs. That's not a condition of a bear market. So this is all pointing well north. The TSX has recently just broken out to a new high, and this is a big deal when we get into the commodity discussion. My main thesis for 2018 is that commodities will be the place to be. And we've had a huge push up here. This would be, in a big picture, this would be called a bull flag. And so you go up, you consolidate for a while, and now we've just started to break out. And I think if commodities are starting to break out, we'll cover off the Australia market, Russia, Brazil, London to some extent. But as we go through these markets, you're going to see that they're all starting to break out, and that would be a sign that probably commodities are going to behave a lot better. Here's Mexico. We recently made new highs in July, and then we've been working our way a little bit lower. We're just kind of in a trading range here. This still isn't bearish. We've still got higher lows in place. So this is still on a buy signal, and objective is 4,400, and we're at 3,400, so it's looking for a 25% gain. Here is so now we're going to go over to Asia, and this is the Dow Jones for Indonesia, their stock index that they've created. And what you see here is this has been working its way higher. Here's 2017, not quite with the same robustness that the US market is, quite frankly, just been soaring. And so a lot of these other markets are back and forth, but they're still making higher highs and higher lows. The bullish price objective for this is 1,400, and we were just about there. So I would say that we've hit our bullish price objective on this one so far. So the market might consolidate a little bit more. You might remember on the S&P 500 and on the US markets, we were 20 or 25% above support. These major blue lines are automatically drawn by the computer. And what happened here is when this blue line was broken, it put a red line on the chart saying you're in a downtrend because you broke long-term support. Now what's happened is exactly the opposite. Is once we went past that red line, we're on it'll go back and draw the line to the last low and start from there. And so it draws this trend line at 45 degrees, and that trend line will just stay on the charts all the way to the top. So, almost every market in the world is on a huge buy signal. And so these are just very, very bullish. Here's Australia breaking out to new 3-year highs just in the last month, November and December here. So if you're a commodities buyer, seeing Canada and Australia start to break out is absolutely fantastic. That sets up very, very well heading into next year for a new bull market there. And you can see we've been rising off the lows. We had quite a bit of consternation here trying to get through the previous highs, but when we did, it was a nice pop to the upside, and I would expect that to continue. So originally, when the concept of bull flags came out, it was on these P&F charts that we would get, and you would get these huge flag poles, and then you would get this kind of sideways movement. It doesn't look the same on a bar chart or a candlestick chart, but it was actually P&F charts where the phrase flag pole, and then you got your flag blowing in the wind, and now we've got a measured move to the upside again. Looking at Russia, we're consolidating here after a big bull move. So we're in a long-term uptrend here off the middle of 2017. We've made our our flag. And now the question is, have we got enough support to break out to new highs? So Russia is very crude dependent and a lot of commodities. So we'll see if they can start to reverse here. Obviously, they have some sanctions working against them, so it makes it a little bit harder. Here is Korea. And what we see in Korea, this is considered a kind of tech area, but this is, big, huge flag up, and then this flag blowing in the wind comes down. We start to break out to higher highs. You can see the trend working up. So now we're consolidating some of these gains. The target is 26.29. And so here's your price objective at 2,600. We pretty much met it, and we're just consolidating under that range. If we go into Shanghai, and what we see on the Shanghai market here was a huge downtrend all the way into 2016. And you might remember commodities were downtrending then as well. Now we've seen 2017, and we're starting to make higher highs and higher lows and work our way out of here. The price objective is 3,800. We're currently, 3,296, 3,300. So there's a 500-point move here, or about another 15% just to get to our next target. Here's Hong Kong. That looks like a bull market to me. Support is at 23,300. We're trading at 30,000. So you're looking somewhere in the order of a 7,000 point decline, or this line has to ride up eventually way over here, and this market would kind of continue sideways or start to drip. And as they get together, then you'd end up finding your bearish price objective. The bullish price objective of 26,800 has been met a while ago. That was way back 26,000 in here. And you could see the one thing I wanted to point out on this scale is the scale was in 50-point increments going up to 25,000, and then it jumped to 500-point increments. So if it continued the same scale of 50 points, obviously this would be a much more ballistic move to the upside. But there's a scale change here, and it's based on logarithmic price. So as the percentage change gets too much, then it'll make the scale bigger. So there's nothing on the chart that tells you that. You just have to watch the scale closely. But it was the scaling method was figured out a long time ago by commodities traders, and they just found that the chart was going too vertical, so then they changed the scale. Getting into Japan, you can see we've been consolidating for, let's see if we can get down here. So doesn't even give us a date on here. If I was to change the scale, we could perhaps get it. But our bottom line is we have a bearish price objective. And the reason is we made a low and we haven't made a higher high since. So if this was to push above previous resistance, this would be a bullish price objective very quickly. We could sit right here, and right now the price objective is 21,300, and that's based on this consolidation pattern. So so I wouldn't take the bearish price objective too much in heart, especially when you're trading within ticks of the high, unless you really wanted to short the Nikkei. And the only thing I would say is if the yen started to rise dramatically, you might see this Nikkei actually fulfill that commitment. Okay, here's Vietnam. And again, this is in US dollars, not in local currency, but we've just broken out into a new bull market. You can see the scale across the bottom here. And if we wanted to, we could change this scale like I showed you before, just by picking rather than traditional method, and you pick our box size. This is currently 50 cents. We could pick whatever, 10 cents, so 0.10. And put that in, and that's going to make the chart look a little different. But what you see here is we're, making higher highs and higher lows. It's consolidating within a range right around, 1620 to 1730. You're still making higher highs here. So you're on a sell signal because the last signal you got was a lower low. And if this could poke above this 1730 high, and get into 1740, then you'd be on a buy signal. So one of the things about the P&F chart is this whole range in here becomes the range for the difference between a buy and a sell signal. So when we talk about bullish percent indexes, it would add up into that range. Okay, I'm going to hustle through. We're not going to have time to cover off the commodities, but the point I want to make here is here's the FTSE. It's basically just banging its head against this area here. The rest of Europe is actually doing a little bit better. Here's Germany. It had made a huge flagpole consolidating and recently started to break out again. Here's France. What you see here is making higher highs. This is a bullish move. So globally, we're just in this big bull market. Here's Amsterdam. This market's moving higher. Looking at Spain, this market has been consolidating quite a bit, and they've had the Catalan separation going on here, but it still has a bullish price objective as long as we continue to make higher lows. So if this was to drop down below 10.1, we'd get a bear signal. Looking at Italy, basically consolidating sideways for the year. It hasn't done anything. It has a bearish price objective because we made a lower low. And so that's one of the few markets in the world that's actually looking weaker. Greece is just fine. And, you know, this big move up, it's probably come back consolidated. And I would suggest now bullish price objective is 909. That's past the top of this chart. So things look pretty good for Greece. And we've just recently moved on to a new bull market there. Looking quickly into Brazil, we've got sideways consolidation. I still think this is a big uptrend. This is a great definition of a flag pattern where you see this big pull and a gentle pullback. And now if it was to start to break to the upside here, you still got rising lows recently. This would have given you a bullish signal here when this box became higher than that one. So we have a bullish price objective of 83,500. We're at 72, so that's 11,000 points. That would be quite a move. And looking into Argentina, I think that's a bull flag. That's just headed vertical. So that's a commodity market. Here's Chile. And Chile is big in the copper business. So as Chile goes, copper stocks typically go. But what you can see here is this has been a big move up, a pullback. And now it looks like we're on our way back to kind of challenge those highs. Bullish price objective is 1185. And I think that's the last one. I don't have enough time to get into the commodities, but perhaps I can cover those off on the commodities countdown on Thursday and release that as a special kind of PNF edition. So hopefully that helps you out. And with that, I'll turn it back to Tom.
All right, sounds good. Actually, that was a great presentation, and you know we're going to have you back. So you'll have to be ready for that next presentation. Everyone clamors to get your updates. And so no doubt we will get into that. As you can see, here was some of the summary of what Greg was moving through or trying to get through. And as he said, he'll be back and we'll continue to get updates from him. So what that does is leads us to our next segment, which is agree or disagree. And we've got Greg to stay with us here because this one should be a very lively topic. And it's one that I know we get a lot of questions about. But I know that, gold miners, we've got a lot of discussion with interest rates going up. The dollar, had been pulling back, trying to hold on to support. And of course, the impact that we see with the dollar on many areas of the commodities. I thought a great topic for today on agree or disagree would be the gold miners, GDX. So the question here is, or maybe the better yet, the statement is gold miners are a great place to trade right now. And with that, do you?
I don't think that was the actual.
Which one was it? I thought it was GDX.
It is GDX, but is it time to buy GDX? I think your adjectives maybe gave away a little bit of what your opinion is.
We'll see. I mean, would you be a buyer? I mean, as from a trading perspective, is it worth jumping into the GDX here? I mean, are you a buyer? Are you a seller? What are you doing with GDX right now?
All right. I'm going to go first since you guys have been talking a lot. Well, Greg's been talking. Let me go find what I want to find here. All right. I have it set up. I'm going to show you why I think gold and miners look good right now. I'm bullish on both of those, and I want to show you all why. So let me see if I can go find my chart. Not sure why it's not showing up in there. I'll try one more time. I had some beautifully annotated. There they are. Okay. Here's my gold miners chart. All right. So I just got that PMO buy signal. I'm seeing a little bit of life coming back to the scooter. Admittedly, not particularly excited with the volume setup, but there's my short-term trend model buy signal. I think there's some good upside potential, although, I think the 23 level is going to be a little bit difficult. But I would have to say, looking at GDX, I would have probably wanted to get into it earlier, but I think it does show some momentum right now. The question will be what happens with that declining tops trend line. And I do like gold, though. I still like gold, and a lot of people are ask me, well, I don't understand. Gold is doing great. Why aren't the miners doing great, and vice versa? And really, the simple answer is that gold is actually a commodity, and the miners are stocks in the market, so they are. They also have to deal with what's going on with the market as a whole because they're companies being traded in the market. So anyway, gold, everybody who's been reading me knows that I've been bearish on gold since right about here. Missed out on that rally, but it didn't make it past 1300. It's now breaking above that 1265 level. I already was liking it based on my PMO starting to turn up. We don't have that buy signal yet, but this is the place where I usually like to get in and start thinking about it. But what I wanted to point out, with gold as well, is that, we follow the discounts and premiums on the gold trust. And we had a really high discount yesterday. And that typically is a good sign of a rally because it's sentiment, right? So things are obviously very bearish if the discount rates are high. So what I've done is when we've had those other ones, I have marked what has happened, and we got some really nice rallies off of those. Yes, there was this one, which was a failure, but look at what the PMO had just done. You could see the scooter. I think there were plenty of warning signs to say that, yeah, this bearish reading is probably because things are bearish. So anyway, my opinion is that, I think GDX, miners, and gold are looking pretty good right now.
I'm stealing the screen.
Yes, your turn. We're going to gang up on Tom, so let's get started.
Yeah.
You don't even know what I'm going to say. Well, maybe you do.
Yeah, I think we do.
Yeah. Okay. So the bottom line is here's RRG charts. And what you want is everything kind of turning up and heading northeast. And these are just started to turn up well, still on the positive side of center. A lot of these are the miners. This is GDX and SIL, which is the gold and silver. They've actually flattened out. Next turn, I would expect probably by the end of the week, we're going to be going higher. But these ones rotating on the right-hand side give us a clear idea that what the leadership group is doing is starting to rotate up. So I'm extremely bullish, have been for a while. I think my commentary for the last months has been that we're going to be setting up for a gold low in December and trying to break out. And if the US dollar starts to pull back, like I think in 2018, this will be a ride for the ages. So we're actually expecting this breakout here. GDX is starting to outperform GLD. When you can break these trend lines, this is a good place to get on board. As you can see down here, this is GDX in the lower screen. So when we start to break out from these levels, it's a good place to get on board. Now, the run that I don't have on this chart, and I'm just going to add it right now, is the 2016 run. And the point would be when this break happened here, so there was a downtrend. When we broke out here, this move was 150%. So I just want people to be aware of how big this could move. So we've got a nice 18-month downtrend line. We're testing it on XGD, or if I change that to GDX, you'd see the same thing. But the bottom line is the miners are starting to outperform up here. This is a huge buy signal. Some people are comparing gold to the S&P 500, and yes, there's a big downtrend. I agree, but you want to buy the gold stocks when they're near the lows, not after they've broken this thing out to the upside. That's way late. We want to get that move of 150%, this kind of surging move that we got. Here's the GDX on this chart. So this thing, when it starts to take off, you really want to be on board. This is the HUI, the Gold Bugs Index versus the S&P 500. Fully agree, downtrend, got it. But we've just broken this trend line on here. And when you get these trend line breaks, they're a nice place to get on board. The big thing for me is I think the US dollar is going to actually fall quite hard in 2018, pull back just as everybody else moves into the emerging markets even more. And that move in the US dollar, I've been covering it on the Commodities Countdown. I'd encourage you to go see those videos. It's huge. And the one chart I want to leave you with is this is the forecast for copper. Copper and gold in some reservoirs are found together. But what you see here is 2017, currently we were undersupplied. We expect to be undersupplied for the next 2 years. And then this is the problem. The demand for copper is expected to rise. It takes almost 10 years to get a mine approved these days. And we don't see that changing anytime soon. So they're going to be going into the gold mine to try and get the copper. They're going to go into the copper mines trying to get more copper. But as that comes, they're going to try and get more. They're going to get more gold. I fully expect the price of gold to soar with the rest of the miners, and it's going to be a ride, a really good ride for the next little while. I'm very bullish through. If this trend continues to break, I'd be really bullish. And if the big trend on this HUI chart breaks, there's a huge reason to get long, and I'll just show that to you, and then I'll pass the torch to Tom. When this trend broke here, this was that 150% move we got in the miners. So just watch this. We're not too far away from breaking out of that. And if it was to happen, I think the move you're going to get will be stunning. So anyway, I'll leave it with Tom.
Oh my gosh.
I know, right? I think we laid out pretty good cases, though.
And I think Tom, by the way, Canada, Australia breaking out to new highs. Just a news flash for you there.
Okay. First of all, before I even get into this and all that nonsense I'm following, a couple of things to keep in mind. First of all, I'm a momentum trader. So I want to trade things that are outperforming the S&P 500. I don't want to trade things that are underperforming, hoping that it begins to outperform. So here, when you look at the GDX relative to the S&P 500, here was the period you were talking about, Greg, the 6-8 months where we've had a nice move.
150%. Yeah.
Yeah. And about, what is that? Maybe 1/4 of what it lost over the prior 4 years.
You just have to be in it when you get the signals. We just got the signal. That's the point. I don't need to be in it the whole time. You want to be in it when the signal shows up.
Well, I guess we differ in which signals we're following. What I'm looking at right here is over the past several weeks and couple of months, is this relative ratio of GDX versus the S&P 500 continues to go lower. So yeah, we're starting to see movement to the upside, but it's still underperforming the S&P 500. So until it starts to outperform the S&P 500, personally, I don't have any interest in it. So that's number one. I mean, I think if you look at, and I think you made comment earlier, maybe before the show, that the GDX is outperforming gold, but I don't like gold. So to me, it's comparing two dogs. One dog maybe is a little bit nicer than the other dog, but I think they're both still dogs personally, because again, what I want to see is I want to see that breakout. I want to see this group outperforming the S&P 500, because my trading strategy is to try to outperform the S&P. And for the past, I don't know, I guess maybe close to 18 months, the GDX relative to the S&P 500 has been dropping rapidly. So yeah, maybe in the short term, it's starting to show some positive signs, but my strategy is not to try to find reversals in a downtrending group. It's to actually see them reverse and then start to trade off of that strength during pullbacks. So I'm not seeing it. Now, this is one chart. I'm going to give you one more. And this is this kind of answers another question I saw in the chat room earlier. There was a question about the 10-year treasury yield, the TNX, and the dollar. And could I, talk about the correlation of the two? And we're going to get into correlation later. But I think for purposes of this exercise, the agree to or disagree, I think it kind of comes into play as well. One thing you want to be careful about when you're looking at interest rates, the 10-year treasury yield in the U.S., and John Murphy, I give him credit. He pointed this out a while back. And I thought this was a great tip when you're looking at intermarket relationships. It's not so much what the 10-year treasury yield is doing. It's not just about what rates are doing here in the U.S. It's also about what rates are doing here in the U.S. versus what rates are doing elsewhere around the world. Now, I've always found very strong correlation between what goes on in the US and what goes on in Germany. So, what I've done on this chart is the top part highlights over the past 5 years the difference in the 10-year Treasury yield here in the US versus Germany's 10-year Treasury yield. And so, as you can see, during the 2013, 2014, and into 2015, US rates were moving much faster than Germany. And check out the movement in the dollar. The dollar followed suit to the upside. And if you look at the GDX miners, you can see that the miners were taking a hit to the downside. The other thing is this correlation. You can see that the correlation between the movement in the Treasury yields in the U.S. versus Germany positively correlates with the dollar, much more so than if I were to pull up just, and I'll do that real quick. I'll come back to this chart, but let me just get rid of the difference between the two, and let's just look at the 10-year Treasury yield and take a look at the correlation. See, the correlation goes much more negative here. So if you're only looking at the 10-year Treasury yield, then I think you could have some issues in some of your conclusions that you draw. So if we go back to that other chart, now you're going to see almost all of that correlation in positive territory. So it's really what the U.S. is doing relative to Germany. Now, where I really have problems with the GDX is that during the first half of 2017, we saw the 10-year Treasury yield here in the U.S. going down relative to Germany. We saw the dollar pretty much free falling for 8 months, and yet the GDX barely budged to the upside. There couldn't have been a better backdrop for gold and gold miners to be moving higher than pretty much a straight move down in the US dollar from 102 down to 91 or 92, and yet still not much movement to the upside in the gold miners. Now what we're seeing is we're starting to see the US rates rise again faster than Germany. We're seeing the dollar, which recently moved up. It's maybe consolidating. It hasn't put in a new low, that's for sure. And we're seeing the miners begin to drift lower again, all while the S&P 500 has been setting new all-time highs. My strategy, and I don't know that I completely disagree with you, I think a lot of it is just our timing. I am not going to get involved in areas that are not outperforming the S&P 500 because it's going to make it almost impossible for me to outperform the S&P if I'm trying to trade areas that are underperforming. So I don't know if you all have a rebuttal, but
commodities are all about trading near the lows, not waiting until they break out to new highs. And so I think the biggest thing is you're waiting for the setup. If I'm right on the US dollar is going to break down hard next year. I expect it's going to be a move of the same magnitude of 2002, 2003. And I think that change in trend is so big. I think the miners go ballistic. And I think Freeport breaking out in the last couple of weeks, starting to show it. I mean, if I showed you my full stochastics reversal scan today, it's filled with gold miners. I love that trade on weekly full stochastics. I couldn't be hungrier for the trade. And the nice part is I get to put my stop nice and close if I'm wrong. So I'm thrilled to be all over gold here. And the miners have been, over the last 10 days, the miners have been unbelievable. Put up that FCX chart just to get a feel.
All right, we agree to disagree.
I think
not like gold. I will say this: you talked about copper earlier, and I do like copper.
And when did I get you into energy? I think it was like June 29th.
Yes, and I avoided energy for 18 months while it was downtrending. I waited until the break.
You got the break in what, November?
Yeah. I mean, these companies are just starting to post great results. They're pulling back to key support levels. That's my strategy. So I'm good with energy right now.
Okay.
I own one, but gold, no, thank you.
Okay, everybody, we're going to be done. You can vote on the platform there.
Yeah, and I've been watching, and it's we've made really good arguments because a lot of people are not even voting. They're kind of just saying, wow, those are good arguments. I'm not sure. So we'll have to see.
You better get into 10 and 10, otherwise we'll be.
Yes, we probably should. But I would say that, let's see, in summary here, let me get
we are all great friends, by the way. We had this same type of debate going on before the show started. So we just kind of carried over. Some things we agree on, some things we don't. That's the stock market.
Yeah, it's just how it works. And we all have our different analysis. And I do pay attention to correlations and what's going on. I thought your presentation there at the end, that chart was very compelling. So
Again, I'm not trying to time bottoms. I'm not a value person. I don't try to get the very bottom. I don't care about trying, because to me, when you're trying to catch a bottom and you have tight stops, you're just continually being stopped out with my strategy. So I have to see that strength start. And then once that strength starts and I see pullbacks to key areas, I can set my stops. And if I'm wrong, I get out really quickly and I can just kind of move on. So it's not my strategy to try to find a bottom. That's all.
Yeah, well, I have to agree too with Greg. It's usually trading ranges with the commodities. So, it's a simple, when it gets down to support, buy, and when it gets up to resistance, sell. But yes, I think you make a compelling argument. I actually have put down, so I'm bullish on both gold and miners. Greg is extremely bullish on miners, and from what I can tell, the audience isn't quite sure, although it does seem to be leaning toward the buy side. So we're going to start the 10 and 10 here, a little bit late, but I'm sure you are up for that.
Let's do it.
Challenge. All right. So the first one we had, as we told everybody else, is CBI.
All right, Chicago Bridge and Iron, and I think they were just. Maybe I'm dreaming this, but I thought they were just acquired, or they just got into some partnership maybe yesterday.
I think it was a merge, or yeah.
But they're not certainly reflecting that in the stock price. That's why I'm wondering if maybe I read it correctly.
Yeah, be sure and get your screen up there.
Oh, I thought I had it.
I'm showing that I still do.
Okay. All right.
There we go.
Thank you for that. Okay, so CBI, let me go ahead and annotate here. And the recent highs, I think that there's pretty good resistance. It comes in probably about 1850, 1875. You can see a couple of tops back in July. You also can see some bottoms here from back in May and June. So with the exception of this move here, I say that that's a pretty important level where we've seen prices pivot off of. And now we're moving back to the downside. For me, I think, again, this is not a stock that, in my opinion, is a great trade. It's been downtrending throughout most of 2017. I think it's in a trading range for now. So if I was going to trade it, it would probably be between this range. But I think there are many other stocks out there that look better. So I would pass on it.
All right. The next one, and talk about a trading range, BBL. Right. And I know I'd be waiting for a breakout before I touched it, because that trading range has been in effect for quite a while.
All right, BBL. So let's see here. Yeah, I love the pattern. I think this is a really nice bull flag, sideways consolidation after the uptrend. So if I was, just going to give it a quick annotation, to me, there's the uptrend. It looks kind of like the TNX, the 10-year Treasury yield chart. But anyway, there's the uptrend. I do see sideways consolidation. So we've got tops there. We've got bottoms here. I completely agree with you, Erin. I would not be buying here because you're right up against resistance. So it's not that I don't like the chart. I just don't want to buy at resistance. I either want to see it get through and buy it on the breakout, or I want to pull back. Now, it may come all the way back to this support level, or it may simply just hit this rising 20-day moving average. So just depends on your trading style and whether or not you want to maybe think about a short-term trade or entry. But I would look for, on any pullback here, if we're starting to make this run, we're going to get the breakout, then this rising 20-day moving average there should be pretty good support. MACD looks good, so that would normally indicate a rising 20-day test would be a great entry.
All right. Let's see. Next one, JP Morgan, JPM. And this has been a buy and hold of mine for, 2010, I think, 2011.
Yeah, well, it's been a great stock to hold that long, no doubt about it. I mean, the
dividend paying, I think it's been pretty good.
Yeah, this one has broken out. I love the financials, especially with the Treasury yields moving higher. This is a group that tends to perform extremely well during periods of rising interest rates. And you've got the recent top. You can see that black candle off of the uptrend, kind of marked a short-term top, but so far the rising 20-day has been holding. I think your big support is at the combination of your 20-day, which is just above 104 here, and price support down at 102. So that would be an accumulation range for me. But I think the volume trends look good here. I love the banks. I think interest rates are going higher. So I like JP Morgan. I would not buy it or add to it at this level for the same reason I just talked about. I think we're sitting right at resistance. So I'd want to either see that breakout with volume picking up, or I would be looking for a pullback 20-day moving average and 102 price support are the two levels I'd watch.
Okay, let's see. Number 4, Lumber Liquidators, LL.
Yeah, this one has been pretty volatile over the years. It's gone through some big uptrends, some big downtrends. It is trying to turn back up after holding on to gap support. So I found the August 1st trade that particular day, and that was earnings related. And you can see it actually gapped up right to price resistance and kept moving up. And look at that volume. Now, normally what I would say is I'd be looking at support at this area on a pullback, but check out the volume on the way back down and then eventually moving below. The bottom of your gap support is all the way down around 25. It went into this gap support zone and then turned back around. You can see lower low, higher MACD. So we did have a positive divergence. And as soon as we got back up above that breakdown level, we continued moving right up through the 20, through the 50, and now moving up above it. I like the action. I like this move above the 20-day moving average. I like the MACD just making a bullish centerline crossover, and these pullbacks have been holding that rising 20-day moving average. So short term, I am bullish the stock. I do think that it's probably going to have some issues at between 33 and 34. This was like almost a head and shoulder kind of a top here, left shoulder, neckline, head, neckline, right shoulder breakdown with volume. So as you get back up here, you've got neckline resistance to deal with. But I think short term, it's probably going to make its move for 33, 34, and then we'll reevaluate.
All right. Let's see. And the next one I have for you is Kinder Morgan, KMI.
Yeah, well, it's definitely in a space that's been getting a little stronger, although I believe this one's in the pipelines, which might be a little weaker than some of the other areas. I see a major resistance level that it still needs to try to negotiate. I do like the fact just that the overall sector is much better than it was, but you can see the failure right here at price resistance. We had 3 tails up at about 18.15 or so, and then failure coming back down. But look at the MACD has gone positive. Now, one thing that needs to happen, it didn't happen the last time, but if we truly are bottoming, that rising 20-day moving average should hold as support. Look what happened the last time we had this configuration where we got very bullish. MACD looked great, big volume gap up, looked like we were turning the corner, and then came down. The 20-day offered no support whatsoever. We went right back down and continued trending lower. So that's why I think here we want to keep an eye. And this could be a bottoming head and shoulder pattern as well. Left shoulder, neckline, head, neckline, right shoulder on the 20-day, and then a breakout would actually measure probably up another $1.50 or so, close to 1975, maybe up to this high over here. So there are some positives here, but a breakout above 1815 is what you're looking for.
All right. Let's see. The next one is Square, SQ. And, it looks like that parabolic broke, but it's finding a base right now. I don't like it so much, but it does have a high scooter.
I bought it this morning.
Well, there you go.
Full disclosure, I like Square. They've reported blowout numbers, but they were anticipated. I mean, this is just a huge move to the upside prior to earnings. They came out with their earnings, and pretty much it was a buy on the rumor, sell on the news episode. I think what we're doing is actually eventually going to put in a cup, and I think this is just starting to bottom. We may have a little bit more to the downside. So what I would be watching is, I think, number one, this is a recent area of support, which is why I bought today. But I think also these tails down here after making the move at the end of October, you see volume really starting to pick up on this move. These were the reaction lows down around 34. So I think this is going to be a really key area. The volume is starting to come out of the stock as it hits in this support area. I think it's basing and is ready to turn up. I love the reward to risk on this one, although Square is very volatile. So keep that in mind. And I do want to show you one other thing real quick that was maybe the final reason why I decided to jump in. And that is on a weekly chart. If you pull up the weekly chart, it is about to get a 20-week test down around 34, a little above 34. That would be the first 20-week test that it has had since probably back a little over a year ago, October of 2016. So, and I think you can see that parabolic move that Erin was talking about here on this weekly chart. Anytime you see that, you really do need a pullback to get rid of all these crazy overbought conditions. I think we're getting that. So anyway, full disclosure, I own that one.
All right. Let's see. The next one I have for you is pey.to.
All right.
I'd say if Greg wants to weigh in on it a little bit, since it's a Canadian.
I like the positive divergence here. So I do think that it's going to go through that 20-day moving average. I'm not sure that the overall trend here has changed, but what I would look for is maybe a retest of these recent reaction high, maybe around 16. And as the 50-day comes down underneath, that would give us maybe a 50-day test simultaneously, because we have a higher MACD with lower price action. And now we're moving back up, and a close above the 20, I think, will take us up to a 50-day test. Any thoughts on that, Greg?
Painted Pony just has, if I'm not, or sorry, Pato, I think they have a little bit of debt issue. So, so that's part of the problem there. But in general, I'm looking for natural gas stocks to start to turn higher. The one thing, I'll cover it off quite intensively tomorrow on Commodities Countdown recording, but the big thing there for natural gas is it usually makes a low in December, rallies a bit, and then makes a lower low towards February, March. So it might be just kind of drawing everybody in here, and then we'll start to get some rallies later on. But the problem with that chart, I think, is debt. So that's my guess.
All right. And my approach is that that's already built into the price as a technical analyst. I mean, I guess that's the case with any company, I guess, that has high debt levels. You always have some issues, but those issues, those risk issues, should be built into the price of the stock as well. So I do like the fact that we're seeing this positive divergence, starting to see the movement back up here in the MACD. I think that gives us a better chance to get through the 20-day, which is where we struggled last time, didn't even get up to it. And if we get through, I'd look for a move up to $16 or so.
All right. Let's see. The next one is Global Lithium ETF, LIT. I've just got a PMO buy signal in oversold territory above the 0 line, but I would be waiting for a breakout still.
Yeah, I think we're consolidating. If we had this high up a little bit higher, then we could draw a triangle, but technically you shouldn't have a continuation pattern until you have your final high, which would be here. Maybe what we've got is an inverse head and shoulder, though, with a inverse left shoulder here, neckline, head, and then up here, maybe working our way back up to put in the right side of the neckline. No matter how you look at it, I think we were overbought. We're consolidating. I'm pretty bullish this area. I'd be careful if 37 was lost, but I believe before we see a move below 37, we're going to see a breakout above 41.
All right. Let's see. Next one is Aerojet Rocketdyne, AJRT. And I see a pretty nice looking ascending triangle there.
I think it's AJRD, right?
AJRD, yes.
Yeah, I think the problem I have here is that huge gap down. We are now at the top of the gap. So let me show you. I like the move back up through the 50 and the 20, and I like the MACD crossing into positive territory. But the problem I have is I really want to see it get back through where all the selling began. And so this was the close the day before all of that selling took place. And when I talk about that selling, look at this big red candle and the massive volume. So we've worked our way all the way back up to gap resistance. Can we get through? I think if we can, then I'd be more bullish. Otherwise, I'd be bearish. So I'm kind of on the fence on this one. I'm going to give the nod to the bulls just because we're in a bull market. And during a bull market, we're going to see more bullish resolution than we are bearish resolution. But I would be careful about this level because of gap resistance.
Okay, and our last one will be SBAC, which is SBA Communications. And I see the execution of a head and shoulders, and it's getting close to where you'd want to see it, see some support, but it's not holding it yet. And I know the measurement says that we should get even further down.
All right. I am once again going to have to disclose that I own this stock. Is someone in my portfolio? I actually bought SBAC on the 50-day test, and I added to it on a price support test, which is right here around 157, maybe just a little bit above 157. I think, well, today's low is 156 and change. But I do like today's candle off of this move to the downside. Again, for me, the most important thing is price support. And I look at these, even the pattern, and I see exactly what Erin's talking about. Left shoulder, left side of the neckline, head, right side of the neckline, right shoulder. The problem is I'm not looking for bearish conclusions during a bull market. So I'm not really paying much attention to that. I'm paying much more attention to my key price support level. So I think the top of gap support and this prior high, which then becomes price support on a pullback, I think this is a really key area. Notice also during an uptrend that anytime you get this RSI moving down around 40 or so, it tends to coincide with bottoms. And right now the RSI is sitting at 38.6. So I think that this is the time where it needs to move. I will have a very tight stop. Close below 157, I'll be out of SBAC. So it really does need to turn here. But I like the stock and I do own it.
All right. That concludes the 10 in 10.
Oh, I think he should look for support on GDX, actually.
Oh.
I couldn't find any.
11 in 10.
I couldn't find any.
Sorry, I couldn't find any.
All right. Well, yes, that concludes the 10 and 10. I didn't get them all on my summary slide, but I will have that for you in today's Market Watchers recap. But right now, I know that it's a little bit overdue that I need to give us all a market update. So with that, let's go check it out. All right, there it is. Okay. So let me update this candle glance. And as I said, I did add the TSX, not just in honor of you joining us, Greg, but just because we have had a lot of requests to add that to this candle glance. So I decided to do it. So what you can see is a lot of really volatile trading, in my opinion, a lot of up down going here. But you can see on the Dow, it looks like we're getting kind of a symmetrical triangle. And, those are continuation patterns, and I don't see a whole lot to continue here, but staying on the positive side for the Dow, S&P 500 barely holding on to positive territory. NASDAQ hasn't quite made it there since its big blowout morning to the upside. And yeah, it just took a dive, and it has not been able to get back above into positive territory. Russell 2000 small caps, though, looking pretty good, hanging above yesterday's close, really not hitting negative territory, but once earlier in the morning. You can see TSX also had a nice morning, but fell out, and now has made a nice move here with a nice rising trend channel that I can see there. Likely to continue higher. It is in the positive. We can see Treasury yields up today, reading right now at 24.86. The dollar is down, but it has come off its intraday lows, but it looks like it's going to finish probably in that 24.25 area. We can see commodities are up higher, and USO is forming a short-term flag here. It's on its way up still. And we can see gold having a nice day and a nice rising trend channel. The VIX, like I said, was down below 9 as far as its reading, and is now up right around 9.5. Advances are leading declines. Let me go ahead and take you to see our scooter movers and what I wanted to show you. So here's our top up, which are the biggest movers. And you can see right here, you've got, as far as the big one, FMC Tech. What I'm going to do is put them all on an RRG for you by just clicking RRG. So we can see really what's going on with these top scooter stocks. And as Julius has told us, and Greg also pointed out, and I point out, you want those northeast moves. So at this point, seeing this turnaround for these weakening stocks, and they are starting to show a bit more promise. But I'm looking at these improving stocks, and they're moving over into the leading area. But just because they have really big scooter movers doesn't necessarily mean they're in the best situation. Here's the daily version, a shorter term version. So we can see that HAL, BIBB, those are the ones in that leading corridor heading northeast, as well as PXD, Pioneer Natural Resources. So with that, I'm going to close out our final market update. And I think we have a bit of time to follow up. I know you had a great discussion coming up on correlation, but did you want to comment on anything from that market update, Tom?
No, I think we're pretty flat. So I'm going to go ahead and just move on to the correlation. Chip was on yesterday and talked about correlation, the correlation indicator, and I think it's a really important indicator. I know that John Murphy uses it a ton and in his intermarket relationships, and I think it's really important to go through that. So I'm going to go ahead and jump right in. There were a couple charts I wanted to show, and really what I'm looking at here is the difference in the correlation between the two key asset classes, stocks and bonds. So if you look at this chart, this is a long-term monthly chart going back the last 2 decades. And if you look at the 10-year Treasury yield, you can see that the yield has been going down for the last 20 years. And you look at the S&P 500, and despite the fact we had 2 bear markets, you can see over the last 20 years that the S&P 500 is quite a bit off its lows. So you might look at this and say, well, there's an inverse correlation, right? I mean, Treasury yields are going down, S&P's been going up. Looks like they go opposite one another. But if you look at the correlation, it actually tells you that there's more positive correlation between the two than negative. And I thought that was kind of interesting. And keep in mind that it's looking at this going back the last 20 periods, and this is a monthly chart. So it tries to look at how they perform with one another over 20-month periods, okay? So again, you look at this on the surface and you'd say that this is negatively correlated, yet when you look at the correlation indicator itself, you see almost no periods where it's been negatively correlated. So the negative correlation that occurs apparently happens very quickly, and then the two tend to move together in the kind of the shorter to intermediate term. So wanted to start with that, and let's move on to the weekly chart. And so what I've done, I just showed you 20 years. And so now what I want to do is break it down weekly between 2 decades. So I'm going to go from 2000 to 2000, end of 2009, and then I'll give you a second chart that talks about the TNX versus the S&P from 2010 through the current day. And so what you see over periods of time on the 10-year Treasury yield is that as it moves lower, this was from 2000 into 2003, it was basically declining throughout most of that period. And you can see that the S&P 500 downtrended with it, and the correlation was pretty tight, positive. Then what you can see is that from middle of 2003 through middle of 2007, the overall trend in the yield was up, and that coincided with the bull market that we had in the S&P 500. And then once we topped in yields and we saw this huge decline, you can see this period from the middle of 2007 to about the end of 2008. That's when the yields took their big drop, and of course that's when we had the big crash in the S&P 500. And then since the beginning of 2009, we can see that the yields have been rising, and once again we have the S&P 500 on a big move to the upside at the end of 2009. Now I'm going to move on, and by the way, now on a weekly basis, you can still see that most of the correlation again remains on the positive side, many periods of which we get up between 0.75 and 1, which means they're moving hand in hand to the upside, which is completely different than when you look at that big picture with the yields coming down for the last couple of decades and the S&P 500 overall moving higher. So I think that's a pretty interesting chart to watch. And then you look at here, now this is the current decade that we're in, starting back in 2010. And again, now what I've done here is I've shown the green vertical line that you see on your chart is actually marking bottoms in the 10-year Treasury yield, and the red lines are marking tops in the 10-year Treasury yield. So here during this move back at the end of 2010 to early 2011, we got a move up in the yields, pretty consistent. And you can see the S&P 500 also moved up, and you can see the correlation went almost back to 1. And then we went through a period of about a year where yields were moving lower, and the S&P was pretty much flat. And this is during the bull market, by the way. So when yields are moving down, actually here, when yields are moving down, you can see actually we moved down a little bit, not flat, but we're actually down a little bit. And then we went through a period where maybe you could just say consolidation, but from the bottom here to the top at the end of the first quarter of 2012, yields moved higher. The S&P did well. Then we went through about 4 months where we went straight down in the yield, and the S&P 500 was flat, maybe down a little bit. And then we went through a period of about a year and a half with the yields mostly moving higher. And you can see this was one of the strongest moves during the bull market until this year. We saw the S&P going up with it. And then you can see that this period was probably about a 2.5 year period where yields were moving lower. And yes, the S&P did go higher during this period, but it was also where we had a lot of difficulties, a couple of down moves that scared the heck out of everybody. And we ended the period up, but probably over 2.5 years, the S&P was not up more than maybe 5%, maybe 6-7%. I don't know, but it wasn't a huge move. And then at this bottom on the 10-year Treasury yield, I believe we are still in an uptrend, and look at what the S&P is doing. So I think part of being able to forecast the S&P 500 is following what's taking place in the 10-year Treasury yield. And if we pull up a daily chart right now on the Treasury yield, and this is one of the reasons why I remain very bullish equities, is we are seeing a breakout to about a 7 or 8 month high. And it looks to me like we're going to make a run for that 261 level that we hit back at the beginning of March of earlier in 2017, maybe mid-March. So I'm seeing a very bullish scenario develop. And the reason that this takes place, if you think about it, the 10-year Treasury yield moves up when treasuries are being sold. They have a direct 100% inverse relationship all the time. It's just the way they get priced. So as yields or as treasuries are sold, the price of the treasury moves down, but the interest that's paid on those treasury notes remains the same. It's a stated amount of interest. So as the prices move down, the yield has to move higher. It's not whether it's going to move higher or maybe it'll move higher. It will move higher if treasuries are being sold. So yields go up when treasuries go down. And if you think a little bit further, well, those who are selling treasuries, where are they going to put their money? And then think about why they would be selling treasuries. Treasuries get sold during periods of rising or strengthening economies because as the economy strengthens, global profits, corporate profits here in the US and so forth continue to rise. And they tend to move up very quickly, taking the S&P 500 with it. And during that, until we get to a period where the interest rates are too high, I think normally you're going to see a rise. And I think that these charts are showing that when you see the yields on the rise, stock market's going to go higher. You've got more money to go in. So not only do we always have new money coming into these different asset classes, we also are seeing rotation between the two. So there are periods, for instance, that you might see money, going in or out of both at the same time, depending on what the economic conditions are. But generally speaking, based on these charts, you'll see that if money is coming out of treasuries, it's typically flowing into stocks. And when money is coming out of stocks, it's typically flowing back into treasuries. So it's a really important dynamic when you're looking at the various asset classes and you're looking at the intermarket relationships. And again, I give all the credit here to John Murphy, reading his books and just thinking from a common sense perspective of what could drive prices one direction or the other. This one makes as much sense to me as any. When you listen to a Goldman Sachs or you listen to any of these financial firms that come out and say, we're changing our allocation between bonds and stocks. Maybe we were 65% stocks and maybe 25% bonds and 10% cash. And then all of a sudden they say they're going to go from 65% stocks to 70. Well, that means that money is either coming out of cash or it's coming out of bonds. And so that's the transfer and the rotation that takes place, especially as the economy is strengthening. And what the Fed keeps telling us, and I guess it boils down to whether or not you believe what the Fed is telling us, but the Fed is telling us that the economic conditions throughout the country are strengthening. And as a result, they're looking at raising rates in 2018. And as long as that continues to happen, and by the way, while all this is taking place, the Fed, which built up its balance sheet with all that quantitative easing that took place several years ago, they are talking about unwinding and selling treasuries. So what happens when they start selling the treasuries and others are selling the treasuries? I think we could get a big move up in interest rates, and I think that will be very bullish for money that moves into the stock market.
All right.
So with that, we got about 4.5 minutes. I don't know, Erin, if you had any comments on that, or Greg, if you're
Well, I
here.
just got an announcement that I guess the House passed the tax bill with fixes, sending a final $1.5 trillion package up to the president. So we'll have to see how that affects the market for the rest of the day. That's what I'll be watching.
Yep, no doubt about it. Greg, you still with us?
I'm still here. I'm just watching GDX go up every minute.
Hey, I wish you the best on those trades. I hope you make a fortune.
Oh, absolutely right.
What do you, I mean, I know you follow a lot of different areas of the market. I mean, are you seeing what I was talking about in terms of interest rates moving up? Do you think that we're going to, because I know you're talking about the dollar falling, and one of the problems is if the US rates are going higher, and especially if they're going higher than what we're seeing rates do in foreign countries, that would tend to strengthen the dollar. But yet I know you're talking about the dollar moving lower. You see the dollar moving lower. So does that mean that you feel like maybe the economy is not as strong as the Fed is saying, and that you don't see these interest rate hikes coming?
No, I think the big change is that the rest of the world is starting to pick up speed. The PNF display there showed rest of world in their own currencies breaking out to new highs. As the US dollar falls, it makes the ETFs look even better. But my main point would be, when the rest of the world is on a rip, commodities are usually in a bull market. And another Murphy analysis was, this was from the stock charts training class we did in New York in 2011. And I wrote it right on my slide that day. I went, Murphy talks so fast. How am I supposed to get all these notes down? But his big comparison was emerging market currencies. When they're in a bull trend, that rhymes with commodities being in a bull trend. And so I just see all of these emerging markets, economies starting to take off. That's very bullish for commodities. And I'm expecting commodities to be the trade of the year next year. So the US dollar, it's not that the US economy won't be strong, it's that the strength across the globe is coming in. It's a big global lift. All of the feds are trying to raise interest rates worldwide. They tried lowering them, and that wasn't working so good when we went 7 trillion negative. Mm-hmm. So they reversed and went to the upside, and that was the big change.
Well, I think you raised a really good point, and I think we can agree about this.
There's something out there.
I think I found some common ground here, because I was listening to what you said, and I think that the one thing that could really stymie the dollar is if the strength globally is stronger than the strength we see in the US. And one of the ways I think we'll be able to see that is by comparing the yields in other countries, because as their economy strengthens, it's still pretty much the same, it's still pretty much the same economics that we're looking at. And if their economies are strengthening, then they're going to see their yields going up on their own securities. So I think that the most important thing, and maybe you'll agree with me, is that we need to see in this the relationship. Now I'm throwing up the German treasury yields, but literally you could use a basket of foreign yields, whatever. But as long as as long as the U.S. treasury yields are moving up faster than the foreign treasury yields, I believe that is going to add strength to the U.S. dollar, and I think that will be a major headwind for commodities. But if what you're saying is correct, and it could be, then what we should see is this rise that we've been seeing over the last 3 months fail, and this relationship between the yields here and foreign yields start to roll over and move lower, which would then impact the dollar and take the dollar lower, which would mean that the gold and some of the other commodity trades could work out much, much better. So is it fair to say that this is a good chart to watch?
I think one of the big issues we have, so I read an article on Bloomberg yesterday, and it was about how, the flattening yield curve always predicts a recession. They started the example in 1980 or late 1979 or something. But the big issue is we've been in a declining bond price or declining bond yield for 30 years. If that trend is changing, a lot of the analysis we've done in the last 30 years is going to go out the window. But if you have a global acceleration in bond interest rates, so prices in bonds falling, I think that's bullish for everything else. And based on Pring's six cycles, when you're selling bonds, you're buying commodities and stocks, and that's a really sweet part of the market. And then what would happen is the stock market would actually get sold off and commodities would keep rising. So at the end of the major secular bull market, so let's just say we're in a big one now, that it would be the commodities that are the last group that does well and then rolls over, much like in 2008. Oil and gold were still up in the middle of 2008 and the stock markets were falling. So I think the big thing that's different is the trend change.
All right.
Nobody wants to leave, but we have to leave, guys.
Yeah, we're going to wrap it up right now. I do want to say that was a great discussion, even though we don't agree. We don't always agree on things, but it was a great discussion, great arguments on both sides, and I think all the viewers can certainly pick sides on as to which side they agree with or don't, and we'll know. That's the beauty of the stock market. Give us some time, we'll know who was right, who was wrong.
Exactly.
Not that it'll matter, because then you got another battle you got to pick. But couple of things to announce real quick. Friday, we are going to have a year-end review, so mark that on your calendar. Again, want to thank Greg for joining us today. This Friday will mark our last live show until January 2nd, 2018. I know I'm not that old. The next week, though, the shows between Christmas and New Year's, there will be no live Market Watchers shows, but we will have a best of Market Watchers Live, including many of the interviews we've had recently with some excellent guests and many educational segments. Keep checking back to the webinars page, and we'll be providing you some more details as to those upcoming shows. Again, want to thank everybody for joining in today. This was a great show. I'm glad you could be with us. Please remember to complete the survey as you exit, especially today with so much arguing going back and forth. Be interesting to see what you thought of today's show. We do love to get your feedback, so please complete the survey. As a reminder, Market Watchers Live airs 5 days a week, Mondays through Fridays from noon to 1:30 p.m. Eastern Standard Time. Have a great Wednesday afternoon, everyone. We'll be back tomorrow on Thursday. Happy trading.